American Development Bank. Today, we are delighted to receive Professor Hélène Ray and her presentation, Global Financial Cycle and Emerging Markets. All of our sessions have simultaneous interpretation in both English and Spanish. For those who are attending in person, translation devices are located at the entrance of the room. This session will be moderated by Eric Parrado, Chief Economist of the IDB. Welcome, Professor Ray and Mr. Parrado. The floor is yours. Bienvenido a nuestro seminario de investigación y política.
Welcome to research and policy seminar organized by the Inter-American Development Bank. We have simultaneous interpretation in English and Spanish.
El salón. Hoy nos
Today, we're delighted to have Professor Hélène Ray with us to speak about global financial cycle and emerging markets. The moderator will be Eric Parrado, Chief Economist of the Inter-American Development Bank. Welcome, Ms. Ray. Welcome, Mr. Parrado. You have the floor.
And good afternoon and welcome back. We learned about the challenges of monetary policy and financial systems in our previous panel, so it's highly fitting that we continue with this research and policy seminar on the topic implications of the global financial cycle for emerging markets. We are truly honored to have Professor Hélène Ray with us today to discuss this topic. But before I introduce her, let me provide some context for those of you joining us in person and online. Our research and policy seminar series considers the most pressing economic issues and challenges with the greatest thinkers of our time. Our goal is to connect the world of research on the one hand with the world of policy making on the other hand. And Professor Ray represents this goal perfectly. Through her groundbreaking research, she has transformed how major institutions conduct policy and how we understand the connections of monetary systems worldwide. Today's seminar is especially timely because it takes place within the IDB's 58th meeting of the Network of Central Banks and Finance Ministries of Latin America and the Caribbean. Meetings of this network are held twice a year and are some of our most important forums for regional dialogue, consensus building, and problem solving. And so, Professor Ray, your analysis will be heard by some of the men and women who play key roles in navigating today's highly challenging economic and fiscal landscape. A few words about our guest. Professor Ray is the Lord Bagri Professor of Economics at London Business School. She served as Professor of Economics and International Affairs in the Economics Department and the Woodrow Wilson School at Princeton University until 2007. And she has conducted groundbreaking research on external trade, financial imbalances, theory and empirics of financial crisis, and organization of the international monetary system, among other topics. Professor Ray's research has had enormous impact. Her contributions are prolific, and many of her papers become landmarks in the profession. I'm sure we're all familiar with some of her most influential works, like her paper, The Global Financial Cycle, along with Miranda Aripino, and her paper, International Channels of Transmission of Monetary Policy and the Mendelian Trilemma. Her credentials go on and on. She received the Jürgen Jansson Award, shared with Thomas Piketty in 2014, the inaugural Carl Menger Prize, the 2015 Prix Edouard Bonnefond, the 2017 Maurice Allais Prix, the 2020 Prix Turgot, and just recently the 2023 Adam Smith Award. As I mentioned, Professor Ray will present her views on the challenges facing the global economy today and the implications. Many have questioned if we can expect the world to settle back into a more stable economic outlook without compromising macroeconomic outcomes. Two major changes ahead include the persistence of high inflation and higher real interest rates, and higher geopolitical tensions that cause major commodity markets to fragment. These factors will contribute to higher economic uncertainty and disruptions in trade activity. This new landscape could have big implications for macroeconomic policy everywhere, and especially in emerging regions like Latin America and the Caribbean, the region foremost in our minds today. And so we await Professor Ray's insights on these complex issues. On behalf of all of us, thank you so much for joining us. And after Professor Ray's presentation, we will have a question and answer session. Professor, the floor is yours.
Thank you so much for this very kind introduction, and I'm delighted to be here with you today. I'm very delighted to address this audience, also the audience online. For me, it's a treat, and I hope that if you have questions at the end, we can have some interactions. So I'm going to talk indeed about a rather broad topic, which is the global financial cycle and some implications to emerging markets. Now, I'm sorry it's not going to be in Spanish. Definitely not up to it, but I hope, nevertheless, people online, etc., will be able to follow. There is a translation, right? Yeah, very good. Thank you. So the type of points I would like to make in my 40 minutes are, first of all, the way I kind of structure a kind of world economy in different types of networks and the implication that may have. I will give a little refresher on the global financial cycle and then move on to the impact of different central banks and, in particular, what that means for emerging markets, and finish with some views on what a more fragmented world might mean in international finance. So that's a pretty ambitious agenda, and we'll see how we go. So I like to start my talk by showing you these graphs. So it may be a bit small, I'm sorry for that, if you cannot fully see the countries which are in all the little bubbles, but I think you will get the intuition behind this graph quite easily. So this first graph is about trade, okay, and international trade in goods. And the size of the bubbles is proportional to the exports and imports. And then the arrows that you see are the exports for one country to other countries. And this first graph is in 2000. And this is, so a while back, before the entry of China in the WTO. And you can see that there are some really big bubbles in the world economy if we look at it through the lens of international trade, right? Trade in goods. In particular, of course, the United States is very big here. You also see EMU, which is the euro area, a big trader. You also see Japan, Canada, you also see Mexico, you also see China already a little bit in the, which is not a small bubble, but by no means as big as the US and the euro area, for example. And then if we move forward in time and we go post entry of China in the WTO, and we move the whole way to 2019, then you see the world kind of looks quite different. It's really a tripolar world where we now see in these international trade links clearly Europe, US, and China, okay, which are linked in various ways to different countries, and obviously in the way these links develop, and we could spend more time on this, but I won't today. There's a role for gravity and proximity, et cetera, things that we know about international trade flows. But essentially, we have moved on to a world which looks like it's pretty much a tripolar world in terms of international trade in goods. Now, the reason I show that is that I also want to contrast it to a different type of network. Okay, and this is the network on finance, international finance. And here it's drawn using portfolio assets, so equity and debt securities. And it's the same principle in the sense that the size of a node depends on the cross-border positions, and the flows, the kind of arrows, they depend on the investment in portfolio equity assets in other countries. And here you can see that, so the US is pretty much very big in the center, Europe is pretty big, that's 2000 again, and then we have the UK, we have Japan, and in that world, China is not really present. I mean, it's a very small node in that international finance world. And when we move forward now to 2018, you see that essentially there's still the US, which is still very much at the center here. You still have Europe, which is quite important. And you still have the UK, you still have a few things like that. But you see, China has grown a bit, but it's still not in the center, right? So it's not a tripolar world in international finance. The US is still very much the most important pole, and it's very different than the trade lenses that we have put before. So depending on how we look at the world and the linkages, whether we look at it on international trade or if we look at it in international finance, we have very strong asymmetries. Okay? And that's the key thing that I want to take away from this set of slides. Now, if we think about this importance of the US from the international finance side, so I just want to remind you that we still have pretty much a lot of big dollar area in the world economy. So here it's actually a graph taken from some work by Ilzetsky, Reinhardt, and Rogoff, where what we have is both a kind of declining dashed dark line here, which is the share of the US GDP in world GDP, okay? And that's the right scale here is the right one. So you go from about 28% to about, let's say, 20%. Obviously, it depends a bit on the exchange rate, so it's going to be a little bit volatile, but it's kind of going down. And then you see the other line, which is in a U shape. So 1973, you have Bretton Woods collapse, and so you see the kind of dollar importance going down, okay, with exchange rate becoming more flexible. And then you see, again, the kind of dollar share of currency pegs of countries having the dollar as their main kind of anchor currency going back up, right? And quite sizably. So again, here it's the left scale which is relevant. So we see we go essentially from 75%, we go down, and then we go back up to 75%. And there, some of it is due to Asia and to China, essentially, being closely linked to the dollar as an anchor currency and becoming more important in the world economy again. So in terms of the dollar as a numeraire, we still have quite a bit of a large currency area linked to the dollar. I will pass on this very quickly because everybody here knows that the share of dollar in central bank reserve is very large. The euro is a second currency there, and the RMB is still relatively small. Okay, so this is something that everybody is very familiar with. Also, in terms of the different dollar roles, I expect everybody also kind of knows this type of data quite well. In terms of international debt issuance, international loans, foreign exchange turnover, global payment currency, you see that these blue lines, which represent the US dollar, far outsize are far bigger than the yellow lines, which are the euro, and anything then below, like the yen or the RMB, for example. So we do see a very important dominance of the dollar in all the traditional international currency roles, which have to do with transaction, which have to do with safety and reserves, everything, of course, interacting and being in kind of a synergy, right? These things reinforce each other. We do see a lot of dollar dominance there. And actually, the euro is in some roles maybe a close second, but in most roles is not even really a close second, okay? Now, the only kind of small exception so far has been the issuance of green bonds, which has been more developed in Europe and in euros than in dollar. But that's a small exception. Okay, so we have discussed the importance of essentially thinking about the world in terms of networks, and that means different things on the financial side and on the trade side. And we also looked at the different importance of the dollar in different functions and the dollar dominance. Now, I just want also to remind you of one thing, which is the international balance sheets of the United States in terms of external assets and external liability. And this is with some work I've done over the years with Pierre-Olivier Gourinchas in particular. So here you see from the 1950s until 2022 the external assets of the US. So it's like we take the balance sheet of a country on the external side, and we look what are the type of investment that US residents have abroad. Okay, that's what external assets are. And in particular, we can look, for example, if a US resident has investment in Japanese equity, that would be an external US portfolio equity investment. And we look at the asset side of this balance sheet. We will look also at the liability side. And what we see here, you see it's pretty striking, is that, first of all, we do have a huge amount of financial integration in the sense of cross-border external assets as a percent of GDP going up very quickly after the 1990s. Okay? And before that, financial integration was not as prevalent. So we do see an acceleration of financial integration after the 1990s. And then, what do we find in terms of composition of assets on the asset side? Well, we see that this green area and also this purple area are big. So what are those? They are direct investment and portfolio equity. So we see a lot of portfolio equity and foreign direct investment on the external asset side of the balance sheet of the US. Okay? That's very striking. We see, on the other hand, a tiny bit of debt, but not that much. That's the red portion of the graph. Okay? So that's what we can see from the external asset side. Now, keeping that in mind, we are going to move to the external liability side, and there it looks, so at the same time it looks similar in the sense that financial integration we can also see here started in the 1990s, but it also looks very different in terms of asset composition. The asset composition on the liability side, you see a lot of government debt and corporate debt. You do see also some portfolio equity and FDI, especially at the end of the sample, but you do see a much, much bigger portion of debt. And of course, it's because the rest of the world has been buying a lot of US government debt, in particular for reserve purposes, but not only, also by the private sector. So there is this big asymmetry between the structure of external assets and the structure of external liabilities for the United States. So that tells us quite a few things, the data that we have seen before. We have seen there is a big role for the dollar as an anchor currency in international financial transaction and trade invoicing, as a reserve currency and safe asset. And also, because of the structure of the external balance sheet that I've just discussed with you, as a world banker. Why a world banker? Because we have seen the safe asset on the liability side and the risky assets on the asset side of the balance sheet. So this is what a banker does, kind of taking safe liabilities and then investing in risky projects and making up some intermediation excess return, which in this case, with Pierre-Olivier, we kind of stole from Charles de Gaulle and his finance minister. We called it the exorbitant privilege. Okay, so that's the exorbitant privilege of a position of the US in the international financial system because it's a world banker and a world insurer, in the sense that it provides the reserve assets that a lot of central banks are holding to insure themselves. Now, does it work? Well, yeah, it works in the sense that when we have bad times, in the sense of global financial crisis, and unfortunately we have gone through quite a few. We have the 2007, 2008 big financial crisis. We have had a more regional one, but the euro area crisis. We have had then COVID, etc. During those times, what do we tend to see? Well, we tend to see that the value of this safe dollar debt goes up. And on the other hand, the value of the risky assets, which are on the asset side of the balance sheet, goes down. So we tend to see, effectively, that people holding the safe assets, which are the rest of the world compared to the US, tend to see, to have a capital gain on their holdings, and the US tend to have a capital loss during global financial crisis, because the value of the US assets on the asset side of the balance sheets goes down. It's risky stuff, so it goes down during turmoil time. And the value of the safe assets, the liabilities, goes up. So it's a wealth transfer from the US to the rest of the world. So that's a kind of insurance mechanism, and we call that the exorbitant duty. It's inseparable from the exorbitant privilege because it's due to the structure of assets and liabilities. Now, of course, somebody in the past was upset about all this, and in particular this kind of excess return and ability of the US to refinance in bad times or in any times and to buy risky assets It was Charles de Gaulle that is here in this dollar note. So I just made this graph here to make the point that there has always been a bit of geopolitics involved and frustration involved with this kind of state of affairs. However, I mean, the system has a kind of logic to it, right? There is an exorbitant privilege because there is an exorbitant duty, and there is actually risk sharing being provided by this system. Okay, so now, in that type of world, what we see, and what is an important, I think, fact, is a global financial cycle. So what is the global financial cycle? It's the strong co-movements of financial aggregates on a global scale, from asset prices, capital inflows and outflows, also credit creation in the main currency areas, leverage, and risk appetite. They all tend to co-move. So is that important? I mean, why do we care? Well, I think it matters at several levels. One is about financial stability. So historically, we have seen that, and this is true across countries, and of course there is a lot of work by Carmen Reinhardt and Con Rogoff in particular, but also Guillermo Calvo, of course, and Carmen also and other co-authors on those issues. Historically and across countries, excessive credit and leverage growth are among the strongest predictors of financial crisis. So keeping an eye on these global conditions and why they co-move and how they co-move is obviously an important thing for financial stability. Then there's the issue for global growth, because we also know a bit more now about, with growth at risk frameworks, etc., that financial conditions matter, in particular for the distribution of risk around expected growth path. So again, a boom and bust style framework is not innocuous when we look at expected growth for the downside in particular. And finally, and I won't spend much time on this today, but there's this issue of dilemma versus trilemma, and the fact that if you are in a world with a global financial cycle, that means essentially that even a flexible exchange rate cannot really insulate you fully from this global financial cycle, and other tools, such as macroprudential tools, possibly capital controls, are important in order to have a fully functioning monetary policy, for example, and better stabilization policies. Okay, so the way I see that is that macroprudential policies do open some space potentially for monetary policy. Okay, so let's see a little bit in more detail now what this global financial cycle does, and in particular I will point out a few things for emerging markets in particular. So the global financial cycle, I just remind you, this is this co-movements of number of aggregates here, both on the volume side, capital flows, and on the price side. So let's have a look at first asset prices. What you can see in the data, if you take a very broad panel of asset prices around continents, essentially as many risky asset prices as you can get, so stock prices, corporate bonds, etc., and you kind of decompose the movements of all these very broad cross-section of assets into a global factor, or you let the data tell you how many global factors there are in this big panel, and then regional and idiosyncratic factors. What the data tells you is that there is one actually global factor in risky asset prices, which explains about a quarter of the variance of the data. And the global factor in asset prices is this dark line here that you can see, going up quite a lot before 2007, then plunging at the time of Lehman Brothers, and then recovering some. So that will be the global factor in asset prices around the world. So really taking this broad panel of assets into account. Very interestingly, if you look at what it co-moves with, you see that it co-moves negatively with the VIX or the VSTOXX, or in fact any other indices of uncertainty and risk aversion that you can have. So this global factor in asset prices, kind of global movement in risk asset prices around the world, co-moves negatively with uncertainty and risk aversion, as measured by these traded indices, such as the VIX. Now, do all countries load on this kind of global factor? And yes, actually, it's if you look at all these geographical units, so these are mostly countries here, you see that they all kind of load on this global factor. So there's this co-movement is kind of a general phenomenon, And you see here Latin America, you see here Australia, Asia Pacific, etc. Everybody has this positive loading, and they are quite similar, in fact, on this global factor. So to summarize this part of the evidence, we have one global factor in risky asset prices. It's correlated with global risk appetite. So it goes up if global risk appetite goes up, or it goes down if global risk aversion goes up, of course. And this global factor explains quite a bit of a variance of the data, and everybody seems to be, including emerging markets, seems to be loading on it. Okay, so now the global financial cycle is not only about risky asset prices, it's also about capital flows. Okay, so now we are going to look at the pattern of capital inflows and capital outflows into different countries, right? So we have inflows and outflows. And what is quite striking is that if you do the same type of analysis, so you do a big panel with inflows and outflows across the world, and you ask the data, how many global factors do you see in this? Okay, that's the type of dynamic factor analysis that you can do, and you can test for the number of global factors. Well, what you find is that there are two global factors in the capital flow data. And the first one is represented here. It's the kind of yellow line, and I've put it next to the dark line, which is still the global factor in asset prices. And you see they are extraordinarily correlated with one another. So they co-move. So we are here in a situation really where we have prices and quantities moving together, as opposed to a lot of situations in economics where we tend to see if price goes up, quantity goes down. No, that one, the price goes up, the capital flows goes up as well. So we are really about financial activity here, about a lot of financial intermediation in the international economy happening in times where asset prices are high. So that's why I think we see these two global factors moving quite a lot together. And we also see that it's true for outflows and inflows. That's why it's really a matter of intermediation. We have inflows and outflows going up together with asset prices at the same time. That would be the second graph on the right. Now, if we look a little bit more closely at these patterns, we can look at the correlation. So you have here on the top, and I've put the kind of red thing to help read a little bit this table. So we see that the global factor in asset prices and this first global capital flow factor co-move correlation 0.8. Okay, 0.815. So it's a large co-movement. And I should have said, these two global factors in capital flow, they explain together about 35% of the variation in the data. So it's quite a lot. Now, these asset prices and capital flow, this first factor in capital flow and this global factor in asset price, they move negatively with risk aversion, as you can see, and positively with risk appetite. So we have seen that. And world financial condition indices are negatively correlated with these two factors. Okay. Now, so we have seen this first global factor in capital flow. So now I'm going to take a look at, I'm sure you are dying to see the second global factor in capital flows, to see what it looks like compared to the first global factor in capital flows. And again, both of them account roughly for 35% of the variance of the data. So here it is. Here is the second factor in global capital flows. And it looks extremely different. Okay? It's very different from the first one. This one co-moves with commodity prices. I've put here the commodity price index or oil prices. And actually, it also co-moves quite a lot with global trade. So it's trade and commodities, which seems to be co-moving a lot with this second kind of global capital flow factor. And here, if we look at the loading of the different countries, we do see some heterogeneity. While the first factor loads mostly, which is about this financial activity type of thing, financial intermediation, this first factor loads mostly on advanced economies and Middle East and some Europe emerging markets. The second factor loads more on emerging markets, and it includes Latin America. So there is some heterogeneity here. So the second factor is more kind of important, let's say, for emerging markets. The first factor is more advanced economies and some specific other countries. As opposed to, you remember, the first factor on global prices was essentially everyone was loading similarly. So now we look a little bit in more detail at this second factor in capital flow, and we see that it's correlated very highly with oil price, commodity price, with world output, world trade, world private liquidity measures, very highly, and also negatively with the dollar exchange rate. Okay, so that's an interesting animal. It's very different from the first animal of capital flows. So this second factor in capital flows, it's related to this global trade and commodity cycles. Okay, and that's quite a different thing from the global financial cycle that was more related to the first factor in capital flows and to the global factor in asset prices. So I hope I haven't lost you until here. We are kind of putting the kind of structure in a broad brush of the world, different networks, and then now we have different patterns of flows and in the world economy. And of course, we are going to move one step further and ask ourselves, okay, can we find some factors or some things influencing this global financial cycle and this commodity and trade cycle? And I'm going to be focusing on the impact of different central banks, in particular, on these two different types of cycle. So that's what I'm going to show you now, is what is the role of different central banks, and I will focus on the Federal Reserve and the People's Bank of China in particular. I will say one word about the ECB as well on these patterns. Okay, so I'm going to show you some bit of econometric analysis. So that means it's identified monetary policy shocks. So we're looking at causal effect of monetary policy on these variables, okay, these global financial cycle variables and these global commodity and trade variables. And I'm going to look at 100 basis point tightening here of the Fed, for example, and I'm going to look at the effect. It's going to be months after the shock. So there's a number of months on the horizontal axis. So here is the transmission of the Federal Reserve internationally on these global cycles. So what I've put in green here is where the Fed seems to have a large impact. So you can see that the Fed has a large, when it tightens, negative impact on world financial conditions, world private liquidity, global factor in asset prices, global factor, the first global factor in capital flows, and it increases the VIX. So it increases risk aversion, and it increases expected volatility. So that's the effect on the Fed. If we focus more on flows, you see that when the Fed tightens, inflows and outflows, inflows to the US, outflows from the US tend to go down. You can see that in the first of the green boxes. And if you look at inflows to emerging markets, it goes down and outflows go up. So we have an asymmetric pattern here between advanced economies and emerging markets as far as the capital flow structure seems to be concerned. So what's going on? When the Fed tightens, so this is a decline in financial intermediation, inflows, outflows goes down for advanced economies. That has mostly to do with the capital flows linked to financial activity around the world. And when we look at emerging markets, we see that inflows go down, but also outflows go up. So in net, there's an outflow. Okay? While for advanced economies, you have both a decrease in inflow and outflow. So that's an important asymmetry that we find in the data. Now, I'm going to take a look at another important central bank, given what we have found so far, which is the People's Bank of China. And here, what we see is quite interesting. The People's Bank of China, if we look at the impulse responses on world financial conditions, factor in capital flows or in asset prices, we don't see much. Or the VIX, you see nothing is significant here. You see that these shaded areas, they always intersect the zero, so that means nothing really happens. So the People's Bank of China is not an important factor behind these world financial conditions, the global financial cycle. However, if you look at World Trade or Commodity Price Index, here the People's Bank of China becomes really important. Okay? So we see a very, very strong asymmetry in international spillovers between the People's Bank of China and the US Federal Reserves. So for the second kind of global cycle, commodity and trade, the PBOC seems to be very important, not for the global financial cycle. So if I put that together, what we seem to find so far is that the Federal Reserve is important very much for the global financial cycle. It's also important, by the way, for global trade and commodity cycle. There is some effect there as well. But the PBOC is at the other extreme. It's only important for the global trade and commodity cycle, not for the global financial cycle. And some work that has been done by Silvia Miranda-Agripino and Svetlana Nenova show that for the ECB, it's a bit of in between. We have an impact of the ECB on the global trade and commodity cycle, and a little bit on the global financial cycle, especially post-2008, so in the quantitative easing period, not so much so before. So the ECB is a little bit in kind of in between in terms of international spillovers between the Fed and the PBOC. At least that's what we find so far. Now let me go a little bit deeper into what this all means for emerging markets. So as we said before, interestingly, the Fed tightening has this asymmetric effect leading to net outflows from emerging markets. That was not the case necessarily for advanced economies. And the PBOC, despite not having much of an impact on financial conditions globally, does seem to have an impact for inflows for commodity-producing economies with a delay. So if the PBOC tightens, we see a decrease in inflows to commodity producers and an increase in outflows for commodity producers. Okay, so that's more of a specific impact on the international finance via commodities for the People's Bank of China. Now, trying again to focus a little bit more on the international transmission of a global financial cycle or this type of things in various, using different types of points of view and different types of data sets. So I have these great students on the market this year, Svetlana Nenova, who has looked at how in the data we can identify what safe assets are in terms of elasticity of demands for safe assets, and what type of bonds are substitutes for one another. Okay? And so what she does is that she has a very extensive database of US and euro area-based mutual funds, and using this data, she looks in a very clever way at what are the bonds held by these mutual funds which have a more inelastic type of demand. And inelastic type of demand means you are holding to those assets regardless of what happens to the return, essentially. So safe assets, as you know, have a lot of different properties. They are supposed to be safe. They are supposed to be relatively liquid. They may have some convenience yields. There's a lot of literature now around this. They may have regulatory, be attractive from a regulatory point of view. And therefore, for all these reasons, people tend to hold on to them. That is, they tend to have inelastic demands for these safe assets. And so she identifies in the data by estimating elasticity of demands for each of these types of bonds coming from advanced economies, but all kinds of emerging countries as well. What are the bonds which have the lower elasticity of demand? So you can think of them as if they have more inelastic demand, they tend to be more special. People tend to hold on to them more. Okay? They don't react too much when there are movements in prices. And what she finds is extremely interesting. So she finds that what we think at safer assets, tend indeed in the data to have more inelastic demand. So here you can see that these bars are the elasticities of demand. You see that for the credit rating, the bonds which have the lowest elasticity of demands are indeed the AAA bonds. Okay, so maybe that's not super surprising. Lots of inelastic demand, safe assets are characterized by high credit ratings. If you look at the issuer regions of the bonds which have a more inelastic demand, you see the euro area bonds at the bottom and the United States, and then advanced other economies, and then you see emerging markets. Okay, so the emerging markets tend to have the more elastic demands. So that is to say, when prices move, there's going to be more volume adjustment here. Okay, so that's going to be the, and you can see different emerging markets here in the global data for these US and euro area based mutual funds. You see actually that emerging Latin America has the most elastic demand, okay, for these players. And the maturity, you see that there is a more inelastic demand for the very short term, which are really the safest type of bonds. Now, if we focus on US-based mutual funds within the data, so we throw out the euro area-based, we just look at the US-based one, what we see is that, again, it's the safest bonds which have the lowest elasticity of demand. And you look at the issuer region, again, the emerging markets here are the one with the highest elasticity of demand. You see that there is a little bit of a movement in terms of the geography of emerging markets. We see in particular Latin America is becoming a little bit less elastic for the US-based funds. And, but it's still the case that the emerging markets elasticity of demands are higher than the US elasticity of the US bonds or the euro area bonds. Okay, so this is quite interesting. Again, the bond maturity here seems to be less relevant for the US-based mutual fund. Now, she can do more than that. Not only she can estimate the elasticity of demands and link that to how special the assets are and how safe in a way they are differentially, but she also can look at what happens. How do people substitute across different bonds in their portfolio? So what happens when the US T-bill return goes up, making it more attractive for investors? What happened? Well, so in her samples, again, mutual funds in the euro area and the US, the funds, when the US T-bill return goes up and is more attractive, the funds sell risky US bonds and EM's bond. Okay, that's what she finds. So what you see here is that the bonds that are going to be sold most are the ones where the bars now are the largest. That means there's more cross elasticities, so there are more substitution going on. So you see that the risky bonds, the BB and the BBB and BB rating here are towards the top. The AAA are at the bottom, so they are not sold as much. And you see that in terms of issuer region, what is being sold is risky US and also Latin America, just next. And then you go down and you have other emerging markets, and the ones that are less sold are the euro area periphery and euro area core. Okay? So the patterns of substitutions are quite interesting because you see very commonalities between the risky US and emerging, in particular emerging LATAM, and then emerging markets again. And then you go down and very low substitutability with the euro area core bonds, for example. So that's when the US Treasury bill return goes up. What about another important safe asset, possibly in her data, which is the German Bund, or the German T-bill at the short end? What happens when the Germany's T-bill return goes up, making it more attractive? Well, it's completely different. Completely different. What you see then is that the bonds which are the more substitute to the German T-bill, and so which are sold, are not at all in the BBB or the risky stuff as before. They're actually very safe. What is being substituted when the German T-bill return goes up, what is being sold are the other euro area bonds. So the German T-bill is more attractive. It's the other safe euro area bonds which are being sold. And on the other hand, the emerging markets are less close substitute to the German T-bill. And the US bonds are less substitute. So that tells you that the pattern of substitution and what safe assets mean is very different it looks like the US T-bill is more of a global safe assets, and when there are shocks to its expected returns, that's going to have spillovers, emerging markets, risky US, etc., and you can study that a lot more finely, while the German T-bill is more of a regional safe asset, and when there are shocks to its expected return, that's going to affect more the within your area distribution of portfolio holdings, rather than this international distribution of holdings. So I'm almost at the end. So I think, I'm sorry if it was all a little bit hard to digest because there's quite a bit of information that I've given you. I think it's all kind of ties in together. I want to finish by discussing a little bit world fragmentation, because after all, that's very important given a number of things we are witnessing these days. And I think, as I've shown you at the very beginning, the international trade world is very much tripolar, so multipolar. International financial world is still unipolar, okay, to a large extent. And the question is, are we moving towards more multipolarity also in the financial side, international finance, and what would be the consequences of this? And this, I think, we have to think about it differently depending on how the world becomes multipolar. So I think there are two main ways in which we could have multipolarity. One would be we are still in an integrated world with all these network links that I've shown you, but there is emergence, like on the trade side, there is this emergence of other poles. So we have essentially, we move on the international financial side towards also something like, which is more tripolar, okay? But within quite a bit of financial integration still. So that's one possibility. But another possibility is we move towards multipolarity in a world which itself becomes much more regional. So essentially these networks move a lot, and we have a lot of these connections which are cut. So we have different poles, but really it's like the network is disintegrated into different, maybe 3 different networks. And that's very different, I think. There are very different implications for this, for fragmentation, depending on how this happens. So if it happens in the first type of way, more substitutability within an integrated world, I think what that may mean is that still there's a lot of integration, a lot of connections, but we have now more substitutions between, let's say, the euro area assets, between the US dollar style assets, and between, let's say, the RMB style assets. Then if this is the way we are going, then that can be a very potentially unstable world from the financial side because of portfolio substitution across these different types of assets, which are now going to be even more important because there are closer substitutes. So you are going to be switching quite easily between these different style of assets. So that may generate a lot of instability, especially if we then have shocks hitting the credibility of one of these 3 poles. If we have shocks hitting the credibility of, let's say, the European pole of assets, then you might have a lot of portfolio reshuffling happening and a lot of very substantial capital flows happening in such a world. So that's a world which is, I think, prone to quite a bit of instability from a financial point of view. Now, another issue with that type of world would be there's a lot of interconnections and 3 different big liquidity providers, essentially. For example, what happens when we need a lender of last resort, when we need liquidity provisions, when we need swap lines? Well, we need a lot of coordination in such a world. It's not going to be super easy, I think. So that's a clear danger from the emergence of such a world. Now, the other way we get fragmentation or multipolarity is via this regionalization, but that means a lot of inefficiencies, right? If we start to cut all these nodes, all these networks, and we really go to a compartmentalized world, right? So with trade happening only within one area, et cetera, and very few connections, then there's a lot of inefficiencies now in such a world from an economic point of view. And in that world, probably, there's going to be a lot of local trade, both in goods and in finance. And so we are going to give up a lot of possibilities of having more efficiency in productions, in risk sharings, etc. So my best guess at this stage is that starting from where we are, if we go to a more fragmented financial world, so right now we are quite integrated, as you can see but we are quite integrated with one dominant node. If we go from a more fragmented financial world, well, my best guess is that that's, from the point of view of financial stability, that may not be great. And in such a world, of course, a lot of the fragmentation might come from the geopolitics and not from economic forces, right? So that's not necessarily correlated with a lot of stability to start with. So to conclude, I think that I tried to paint a kind of very global picture here. So sorry to have imposed so much material on you in such a short time frame, but so I wanted to point out that there are these importantly very different networks in the world economy. And these networks can be linked on the one side to the global financial cycle, on the other side to the global trade and commodity cycles, that the various big central banks have different effects on these two different cycles, and therefore that the spillovers are very heterogeneous coming from these central banks because of the networks, because of the importance of the dollar on the financial side. And we can see that these spillovers are very heterogeneous, also very disaggregated bond level data, and I think a lot more work should be done on this. Okay, Svetlana Nova looked at mutual funds. I mean, similar work could be done with very disaggregated financial data on other kind of types of investors. I think the patterns are very interesting, regional safe asset versus global safe assets and transmission. And in the end, if we go towards more world fragmentation because of geopolitics, I think coming from a relatively integrated world, that means probably a bit more financial instability than what we have. If we go straight to a much more segmented world for all the networks being cut and important role. And I think I'm over time, so I'm gonna stop here.
Professor Ray, this has been a fascinating talk. It's practically a lecture for most of us, so thank you very much for that, for taking the time to share these ideas. And now we're going to have an open session so we can have some questions. Probably I'm going to start because this is very useful for us in terms of our discussion regarding our macro report. We're in the middle of the discussion within the team, and probably we are going to prepare using some of your ideas in the next one. And now I am more concerned about how the global economy is doing and what is the possible impact in Latin America and the Caribbean. Because I think we're really self-critic about our policies in Latin America, but one thing that we have been doing a good job is monetary policy. I think central banks have been part of the solution and not part of the problem. They reacted before anybody else, any other region, and significantly. And now they are doing the job to reduce rates, but we are not in the same cycle as the developed world. So what is your take on that in terms of the possible financial imbalances regarding that asymmetry?
Yeah, so I think it's very remarkable that indeed in the rising of interest rate, a lot of emerging markets in Latin America in particular were ahead of the curve compared to advanced economies. And this has played out quite well. also because of the reinforcement of all the frameworks, the monetary policy framework. So it's a kind of, it didn't happen in 1 year. Or it's a long-term work. So it's great to see that. Now, on the downside, of course, so the symmetric question is, should also the central banks be ahead of the curve on the downside? And so there, I think it's going to be super important to look at a number of specific factors. So I think what has helped on the upside has been that monetary policy did not operate on its own. There was in particular very, very massive fiscal support in a number of big economies, in particular the United States. And so this mattered a lot for external demand. This mattered a lot for financial stability as well, to have a lot of guarantees. Also in Europe, we had a lot of not only fiscal support, but we had a lot of guarantees being given to companies for loans to companies, etc. There was a backstop, a very massive backstop, which was put in place for the COVID period. So all these supporting policies, in a way, enabled the monetary policy tightening to operate maybe in more favorable conditions than usually monetary policy tightening operates. And so, if with a tightening and effect on the exchange rate, this went rather smoothly in some sense. Now, on the downside, the question is if we are going to have at the same time still inflation stickiness, which might depend on country by country. So this is definitely something to look at, with weakening of currencies. Again, something to look at. And balance sheet, how strong they are, and again, how mismatch or not they might be in the economy. This is something to look at. So country by country and in an idiosyncratic way, one has to make this judgment call whether the downside is not exactly a symmetric situation from the upside. And the fiscal policy, of course, also in advanced economies is not playing the same role either. So these are things that need to be weighed, right? So I don't think there's a kind of overall view here, because it really depends, I think, on all these characteristics and how they play in different economies.
Sure. No, thank you, Professor Rey. Now we're going to take a couple of questions. So I see Jorge, Carlos, Eduardo, and Joao. So probably if you can take the questions, Jorge.
Yes, I have a comment and a question. One, the comment is about the second and the first factor. In a recent paper that we had published in Structural Change, we have tested your global factor, but we made a division in the emerging market between exporters and importers. And in the sample of exporter, it works very, very well, and we show this elasticity, mainly because there is a strong feedback, in this case, between commodity prices and capital flows. When commodity prices go up, capital flows go in these countries, and the opposite happen. And this do not happen in the case of importer, that is more smooth, this cycle of the capital account. So maybe it's interesting now to test your second factor in this regard. But this differentiation between emerging market maybe is very important in the explanation. And regarding the question, I connected with something that we see yesterday, that was a presentation of the IMF. And in this presentation, we see different growth path for a long term, and we see that no country except one, that is the United States, overperformed the long-term growth. And I was thinking in your idea of exorbitant privilege that was about seigniorage, but if this idea that the central bank, the United States are playing the role of the global central banker, making the interest rate not based on global target but on domestic issues, is not affecting negatively the rest of the countries. And in that case, how do you think that it's possible to make a more coordinated interest rate or monetary policy at global level? Thank you.
Thank you.
Do you prefer to wait for other questions, or?
Oh, I can start, because otherwise I think I'm gonna it's gonna be hard to keep track. Great comment. So yes, it would be interesting to have more fine division across groups of countries and to study in more detail the loadings or how they are affected by the global cycle, whether it is the first one on capital flows and prices, or whether it is actually the second one is probably, as you said, super interesting from the point of view of if commodities are so important. We do have here some interesting variation to look at. And by the way, this is also something that can be maybe a bit forward-looking for policy in the medium to long run, because it is to be expected that the commodity markets are going to be changed quite a bit, at least we hope, because of a green transition. And so there's going to be a different pattern of flows coming from that. So it's going to be interesting to look at that in more detail. So absolutely. And on the, so I mean, this has been a long debate about so the fact that the Federal Reserve is so important in many different ways for the spillovers to the world economy, but it does have a domestic mandate, and obviously there's in some cases there might be some tension between what is right for the domestic economy and aggregate demand, and what is right for financial conditions that may spread in different countries. So I think we are making a little bit of progress, first of all, by discussing these issues, putting them on the radar, and second of all, maybe being a little bit better at modeling spillovers and possibly spillbacks, and so taking a little bit more of that into account. Because indeed, if you have spillbacks from even smaller countries, but which are all correlated, you might have an important effect back into the US economy. And if we have better quantitative estimates of that, I mean, I think that enables us to internalize a little bit more of this spillover discussion in the policy discussions in the US. So I think, we are making progress maybe on these issues.
Excellent. So now we have a question from Carlos.
Thank you, Eric. Thank you, Professor Ray, for your great presentation. In particular, I found very stimulating the last part about the possible implications of fragmentation. One question that I have for you is about the possible scenarios or implications for the US dollar dominance in a scenario of fragmentation, geoeconomic fragmentation. I would like to know your thoughts about that. Thank you.
So I think a fragmentation scenario, again, that's going to depend a lot on how this actually happens. If it happens without too much of, let's say, changes in the structure of these international trade links and some of the international financial links, it's hard to see how the US dollar can be quickly replaced by other currencies. Simply because, as you've seen all these statistics at the beginning, there are lots of synergies and externalities across these different uses of the dollar, and they require very broad financial markets. They require a lot of an ecosystem which is very important and which exists only so far really in the dollar area. So even if we think about the euro area, for example, currently, which is a big currency area, and as we have seen in international trade as well, it's an important area. If we think about the lack of integration within the euro area in terms of bonds market, and the fact that it does mean, for example, that in bad times there is essentially flight to quality to the core bonds market in the euro area out of the periphery, and that creates some tensions. That means, these core characteristics of a safe asset that the US T-bills so far seems to have, or the US government bonds so far seem to have, which is that in bad times they really appear as strong in terms of having capital flight towards them, is not present for the euro area as a whole. So there is a lack of resiliency there in bad states of the world, which seems to impair, the use of the euro area, of the euro currency more broadly. And the euro is probably the better place in terms of, so you can see that if we think about the RMB, it's not even really on the map for many of these things. So it doesn't mean that the RMB will not gain, for example, in importance in specific things like trade invoicing and some commercial trade contract and things like that on trade credit. Of course, if it is pushed by different authorities, it will become a bit more important, but it won't become a global currency in the sense of a US dollar with all this ecosystem, in particular the financial market ecosystem around it, anytime soon. I think it would be very unrealistic to think that. And may not be desirable.
We are running out of time, and there are many questions to be made, but we're going to choose Joao, the last one.
Thank you. Sorry. No, it's very quick. Just about these long-term patterns and connecting these gross flows to instability, because in the 90s, I see it as a period of stability. Right, a great moderation, and a lot of countries in the region gain stability despite this volatility and growth in gross flows. And have you thought about it? Is it a puzzle or just is natural? And the other is about the re-exchange rates, because post-Bretton Woods, my understanding is that they have been volatile as usual, and nothing really changed during the 90s or 2000s.
So I'm not sure we will agree here on the view that the 90s was a period of financial stability. I mean, remember, we had quite a few crises in the 1990s. I will just quote, the Mexican crisis, the Asian financial crisis, the Russian crisis, LTCM, and then we went on, and so we had a number of bubbles. We know the tech bubbles at the beginning of the 2000s, and then we had, of course, 2008, which was built up from, in some sense, 2003, if we look at the pattern of boom and bust. And then we had the euro area crisis. So I do think that if you look at the history of financial crisis and financial stability, what is striking in the data is that you had quite a bit up to the 1930s. Then we had a very messy, chaotic period with, of course, the interwar period and the Great Depression, and then the interwar period. Then we had a period of relative quiet, without financial crisis much between Bretton Woods and the 1980s. And after the 1980s, where you do start to see a bit more of these financial flows and also a lot of deregulation and stuff like that. And the 1990s, we do see a resurgence of a number of crises. I'm not saying, everything is bad in terms of, and when there's risk, it's normal to get crisis. But I think the international pattern in financial history is pretty clear. So we do see quite a lot of volatility in the 1990s.
Thank you very much, Professor Ray. On behalf of the Inter-American Development Bank and this group of central banks and Minister of Finance representatives, we would like to thank you. It has been a really fantastic research and policy seminars. So I hope you're coming back and give us a talk and share your ideas and your thoughts with our team.
Muchas gracias. Thanks a lot to everyone.